World. I hope you all are enjoying your lives. My name is Mariam. I'm the cost and management accountant, and in this video, I'm going to talk about the differences between financial accounting and management accounting. Well, the management accounts are produced for internal purposes. They provide information to assist managers in running the business, while financial accounts are produced to satisfy the information requirements of external users. In my previous video, I have talked about who are the users of accounting information, and in this video, I'm going to break the accounting information into financial accounting information and management accounting information. Financial accounting information is for the purpose of external use. For example, banks, lenders, investors, and suppliers, while the management accounting information is for the internal use, like the owners of the company, the CEO, the managers, or the employees. The next point is the financial accounting relates to the historical data. It is past-headed. It will record how many assets it had purchased in the past, how many liabilities it has to settle down, or how much capital was raised. It's basically from the historical data, right? While the management accountant is future-headed, it looks at the future. Like, for example, managers may create the budgetary reports and then they compare the budgetary values to the actual values and take out the variances. And in the next year or in the next period, they will improve their budget on the basis of the management accounting information, right? The financial accounting is mandatory for several companies. For example, the companies whose shares are traded in the stock exchange. For example, the public company, be it Unilever, Nestle, Johnson & Johnson, and many more, who are the public companies and whose shares are traded in the stock exchange, have the mandatory and statutory duty to produce financial reports, right? While the management accounting reports are completely optional, there is no statutory duty to produce these reports. It just depends on the business what kind of reports it want to generate. Take an example of the wholesaler. For example, there's a wholesale business who provides so many goods to many businesses on credit. So the manager of the wholesale company may feel the need to produce accounts receivable aging reports to see how many receivables there are and how long they haven't paid to the company. So it solely depends on the needs of the business what management reports they need. Financial accounting reports an overall result of a company, for example, how much the profit a company has earned overall. But in the case of management accounting, I may create segmented reports. For example, I want to see the performance of the company department-wise or team-wise or job-wise or class-wise. I can do that in management accounting, and I can create reports according to the needs of the business. Management accounting information is solely for the purpose of internal use and not for external use. Summing up everything, the financial accounting information is for the use of external stakeholders, including the banks, lenders, suppliers, and investors, while the management accounting information is solely for internal use. For example, the managers, the CEO, the CFO, the employees of the company. So in my next video, I'm going to talk about the basic concepts of the debit and credit and what are the elements of financial statements. So you'll have to be stay tuned for my videos because I'm going to create so many videos on the topic of accounting, and I'm going to clear all your concepts regarding the accounting.